Hello, ladies and gentlemen. Thank you for coming along to the Creightons PLC preliminary results presentation for our year to the 31st of March 2018. I'm Bernard Johnson, Group Managing Director, and I'd like to introduce the results, and then Pippa and Paul, our Global Marketing Director and our Finance and Commercial Director, will take over. We've had very good growth this year. We're up 14% on the previous year. Our rate of growth and the growth spikes are unexpectedly high since September 2017, which, as you probably know from the little issue we had to the stock exchange, resulted in manufacturing and warehousing capacity challenges. We were forced, in fact, to subcontract our manufacturing of branded product over a 6-month period. This cost us approximately $300,000 in extra costs above our marginal costs. Those subcontract issues are now under control. We have manufacturing back in-house again, and it's working very well. Our branded warehousing is now subcontracted, which has eased tremendously the warehousing issues that we had. It's subcontracted on a long-term basis. We have no plans to bring it back in-house again. It's working very well. I don't think it will be an extra cost. It will not be a saving, but it will it's handled by experts who are probably more efficient than we are in warehousing, and we'll stick to the things that we're reasonably good at. Our pre-tax results were 1.63 million for the year, up on the previous year by 8%. The non-recurring capacity issues did cause some margin problems. However, the bottom line, as you can see, has remained fairly stable, and we intend to address the issues of margin next year, and Pippa will talk about that in her presentation. We intend to move up the margin ladder fairly quickly. Also, we are very aware that the Brexit impact in supplier capacity, as has happened to ourselves in our manufacturing capacity, is causing issues. So we're finding that our manufacture, particularly on components such as bottles and caps, is now being extended. The lead times are extending from 6 weeks to 10 weeks to 12 weeks, which means we've got to hold much more stock than we did before, which again impacts on your warehousing. But I think everything in that line is under control, and we intend to continue as we are with no foreseeable problems. We do feel that the growth of 14% will continue. It's not a forecast, it's an aspiration as much as an instinctive feeling that everything is going very well on the sales side. Our products are good, our structure is good. We're dealing with the good retailers as distinct from those who are failing. So we feel everything's set for a reasonable following year. I'll now hand over to Paul to go through the financials. Thank you.
Hello, everybody. Today I'll just go through the financial highlights here very, very quickly, and then go through slides detailing a little bit more on each aspect of that, and then pick up in a little bit more detail some of the operational issues that Bernard's talked about and the sort of plans we've got and how we're progressing against those plans later on. So go through the main points. You'll have seen these if you've seen the market. The revenue's up by 13.8%, year on year. Within that, the operating profit is up 8.1% from last year, but the operating profit margin's down. The operating profit hasn't grown as quickly as our turnover, and part of that is the impact of the outsourcing costs we've talked about earlier on. And I'll sort of put a bit more, sort of a few more numbers behind that later on. As we mentioned at the half year, we had an increased tax charge in the half year, and that's flown through to the full year. So the tax charge comes out at roughly 23% this year, and that was a function of an under-provisioned deferred tax charge in the previous year. So we've taken the hit in these year's figures. Again, I'll explain that a little bit more, but that has effectively diluted the earnings compared to the previous year. We decided to maintain our dividend. We've invested a lot of money in the cash, as you see lower down. but we are deciding that we'll maintain the dividend at this stage for the final dividend for this year. And then finally, we have utilised a lot of our cash. Again, a very similar story to what we said in September. We had invested in supporting the growth in the business. Again, I'll flesh that out a little bit more. But we've also, for the first time, paid dividends. And for the first time, we've paid corporation tax, as we've utilised all our tax losses from many years back. So just looking at the operating profit line, as I said earlier, 8.1%. The outsourcing costs, which is effectively the third-party subcontract costs, freight, and offset by our internal labour savings, was 299,000 in that 6-month period. As Bernard mentioned, that ceased and gradually wound down through April and May and ceased in mid-May. So everything's been back in-house now for a month. Operating cost, excluding outsourcing costs, would have been 27.8% had we not incurred those costs. I know that's a lot of what ifs, and we can always say lies, damn lies and statistics, but it's an actual figure. We would have achieved those a much higher growth in operating cost. The story here really is that we've continued to grow revenue organically throughout the period. The pale blue figures is the brands we've sold. So stripping out those brands we've sold, the Twisted Sister brand and the Real Shaving Company brand, you can see we're continuing to see organic growth. So the organic growth sort of 14% between 14 and 15, 6.6%, up 45% with the Broad Oak acquisition, and then again 13.8% going in this final year. So we've got a consistent story of delivering organic growth through our contact relationships and etc. with customers. Within that, we've continued to grow our own brands, the brands that we have equity that we own within the business that add value, and where we have created value for shareholders by selling brands in the past that we've grown from organically from sort of zero. And also a big thing, our branded sales, this is an interesting point really within these figures. Within the branded sales, our export sales of branded products have grown, outstripped our total growth, but we have picked up quite a number of overseas non-branded business customers, in particular Primark and Nardi, who are a retailer in Saudi Arabia. So we're now supplying outside the UK private label ranges to some of these retailers. Again, the operating margin's jumping back. It actually deteriorated, as mentioned. The profit didn't grow as quick as turnover. But again, back at 5.6, and that's important when we come on to look at our aspirations we talked about last year, where we're talking about an aspiration of getting to 6% pre-tax profit, 5% post-tax profit. You know, if we hadn't had this blip in coping with the unexpected sales growth, which came more quickly than we thought, we would have been up at 5.6%. Again, these are my adjustments on return on capital employed, but again, trying to assess the same story, really, the impact if we had not had the two-off adjustments that we made this year. The deferred tax charge would have reduced the return on capital employed last year by 0.7%, but both that and the outsourcing cost would have shown an increase. So whilst the actual figures are a deterioration of 0.9%, the underlying story trying to get across here is that we're continuing, the underlying growth is still going to deliver returns and growth for the company. And again, the same on earnings per share, impacted by the tax. But again, the trend over 5 years is a 4 years, 234% growth. Without going into quite a detailed slide now, really talking about where's the cash gone. We've generated from operations about 1.6 million. Over 2.5 million of that has been invested in working capital. We've increased our working capital commitments to stock and debtors, offset by some creditors, etc. We've spent MPD in advance of amortisation on new ranges that have launched in the year, particularly with Superdrug, where we increased our range distribution quite significantly in the period, and a smaller amount with Aldi, a new customer that's come on stream, and I'm sure a lot people will talk about a lot more during the year. Total dividends paid was 230,000 in the period, and we paid corporation tax of 370,000. Not only did we go into a tax-paying situation, the level of tax we're paying now qualified for quarterly advance payments. So we ended up with a bit of a double whammy in the year when we started paying corporation tax. A lot of these are very familiar with everyone here, but we have increased stock by 1.5 million. It is 37% up. We've already talked about our sales being up 14%, but the forecast sales for the first quarter, when we looked at the numbers this year, are looking at 40% up on the same period last year. And that quarter is more or less in line with the last quarter of last year, where we had significant growth in the last quarter of 2018. So the January to March period, we're seeing the same level of growth going into this first quarter of this year. And that means, so it explains really why we're looking at that growth in stock. Although it's gone up significantly, the ratios have actually come down as we're churning stock a bit more quickly with a higher volume and throughput in the business. And again, debtors are up 54%, as I mentioned earlier, just a few minutes ago. The sales in the last quarter were up 33%. That accounts for a significant part of it. The debtor days have jumped from 47 to 53. About our underlying performance should be around about the 50-day mark. There was a slippage with one main customer over the year end, which impacted on that, which came in very shortly afterwards. Which drove it up, which won't be repeated in future. But it's that is a fact that I can't hide from. Just wanted to present where we're going. We mentioned, we did a slide last September or last year about our plans for growth and our aim to double the capacity by 2020. And I just wanted to explain where we are on that journey. We said we'd look at production management, and certainly in September we were recruiting for an operations manager. So by February we'd appointed a new operations manager who came on board, and the month earlier we brought in a project manager whose first project is to look at our engineering structure and how we improve in on that area of the business. And these are both people who are based in Peterborough, but will ultimately, we anticipate, grow as they get settled in and deal with get their hands around the business in Peterborough, look after the site in Devon as well. So they've started, they're settling in. Bernard mentioned earlier on, they're starting to make difference to the operations. We talked about creating centres of excellence. We have now moved all our alcohol production from Peterborough into Devon site, and so they were the best site for that sort of operation. We've moved jar filling to Peterborough. We will move more production to Peterborough on the toiletry side of the business, but only once we are sure we can cope with that. We don't want to add to the pressures with the underlying operational growth in the business. So it will be a point. But what we've also done is we've reviewed our candle operation in the year. Our contribution was in the teens. We were facing competition from specialist candle operation, and we decided that we either had to invest significantly in the operation to get the profits up, both from a technical point of view, understanding the product, and from an equipment, if you like, and plant and equipment point of view, and really from the view that we could get better bangs for bucks, if you like, concentrating on the other areas of the business. So we've notified the business customers, and we're gradually rolling through a wind down of that operation. And we will then look at selling the equipment. So we're taking, where we aren't delivering, we are taking decisions, and I think Pippa will talk a little bit more about that margin ladder and the implications later on. We have the new management team have brought in a focus on equipment utilisation. So it's how do we get the best out of the existing equipment. They put measures in and started plans of actions to try and drive up the output on our existing lines. But we have mentioned in the past we are going to invest in capital. We have invested in the high-speed bottle line. It has delivered in terms of doubling the output on that particular line, which has effectively increased our total bottle capacity by 25%. And we have ordered another tube filling line, which we're hoping will have a similar impact on tubes. So we're looking at high volume. These have not been largely focused around efficiencies, it's about capacity, but we do anticipate, particularly on the tube line, there will be some efficiency gains, and will improve our competitiveness as we go in, particularly on the high volume value end of the market, the 250ml tubes, the creme de coconut over there. And we also have a target of putting increasing the output on one of our jar lines, again by targeting in capital investment on the bottlenecks on the line to address that side, improve competitiveness and address the capacity issues. We're working on a 2-shift system. We've got 10 lines roughly operating on a late shift, sometimes a bit more, 11, 12. So we've still got the operational leverage we could do is by going to a 3rd shift. At the moment, we don't need to, but we will look at those issues as we need to. Aspirations, exactly the same slides. Well, I think the same slides we talked about before. Our aspiration is still get to turnover of 20 million. We've done 14% growth this year. Again, without forecasting, we're looking at growth again next year. We will need an acquisition to achieve that in that time frame, but we won't do that unless it is the right fit for the business. So as things come across the desk, we will appraise them, and if it's the right fit and at the right price, we will make those sort of acquisitions. And we certainly still have the wherewithal to do that. We're still aiming to pay a dividend of sort of 2% on the current sort of share price, so we've still got an aspiration. We held the dividend this year. Our aspiration is to get that up. As I mentioned earlier, we still want to get our return of capital employed above 20%. We would have been there this year if we hadn't have had the outsourcing cost earlier on in the year. So I still think we're on trend towards those sort of targets. So, we have, as we've put there, we are fairly well balanced. We have been flexible this year. We made a conscious decision to not turn down sales opportunities and to impact on the cost to achieve long-term sales growth. So we made a very conscious decision to outsource the bits of business we could do without impacting on the long-term growth opportunities of the business. And now we've got things back in-house. We're continuing to see growth across all areas of the business. I think that was the right thing to do at the right time, and it gives us the opportunity to still take advantage of any other opportunities as they arise. Okay, Pippa?
So I want to give you some updated context of the category that we're in, and you'll see how one of the reasons that I feel that we're driving such growth in our business is because we are aligned with what's happening in the category. So the UK health and beauty market is forecast to grow 3.6% in 2018. So at a 14% growth, we're outstripping what's actually happening in our category. Very interesting dynamic over the past 5 years is that private label is outstripping branded growth in the UK market. That's mainly because retailers' private label is back on the agenda. They've found that competing on price with major brands is margin dilutive and is not really helping them grow. So they're now back onto the private label bandwagon as a way to differentiate and bring different consumers into their category. And I'll talk through in a minute how we're taking advantage of that. E-tailers currently have a 3% share in the market in the UK, which for some I think they find that quite surprising because there's so much talk about e-tailers and what they're doing. But if you look at, we've got a 23 billion turnover of health and beauty here in the UK. So that means currently e-tailers have a share of about 1.5. They're due to grow probably to about 11% market share over the next 5 years, which would take them up to about 3 billion. So they are a very important part of the market, but we mustn't forget that someone like Boots still owns 20% of market share of health and beauty here in the UK. So bricks and mortar, whilst it may be losing out in certain aspects, like grocery, for example, there are still some specialists, and you'd consider Boots to be a specialist in health and beauty, that are doing very well. Skincare continues to be the largest sector at 12.4%. Hair care accounts for 8% and is set to grow at 3% over the next year. Amazon is key in that e-tailing. They've got 1.3%, so they're doing about 600 million, 700 million currently in health and beauty. Bricks and mortar is losing in certain areas. Grocers are the big losers. But as I said, specialists are winning. Superdrug is doing incredibly well. Boots continues to do well. And there's some other high street players like Primark that are doing very well too. And value for money still remains a key purchasing factor. Whether you're selling something at £10 or £1, value for money is still a key driver in this sector. So just to give you the shape of what's happened to our business over the past 12 months, there has been a bit of a shift, and it's this dynamic of private label. So contract manufacturing represented 45% of what we did last year and has reduced down to 36%. That 45% was really coming out of that Broad Oak acquisition a couple of years ago. We have since rationalised some of the business that we acquired because it wasn't good margin business. So that's shrunk back to 36%, but private label conversely has grown quite dynamically at about 45% year on year. So it now represents 38% of what we do. And our own brand's still sitting at 26% and growing in line with our total business growth of about 13%. The private label aspect there that's interesting is making sure that we're working with the right retailers. So you'll see from the types of retailers that we're working with that we've got a new one that's come into the mix, which is discount grocery. So this time last year, we weren't really trading in that category. We're now trading quite significantly in that category. And we are able to achieve better margins out of discount grocery that we're able to achieve out of traditional grocery right now. And that's predominantly our relationship with Aldi. There are two types of business that we do with Aldi. Special buys, which is these big one-off deals that you see that they do on quite specialist products. And that's what we've done very well at. The margins and the retail price point of a lot of those products are significantly higher than some of their core business. So we're putting out products in Aldi that are kind of $3.99, $4.99 because they're specialist, they're big buys, they do them over a very short period of time, so we're able to get quite good margin out of it. But we're also now winning with them on their core business as well, which again is proving very successful for us. So they're definitely overshadowing the type of business that we're doing with the likes of Morrison's, Tesco and Asda, which are the ones that are really margin dilutive to our business at the moment. So we're definitely transitioning. Beauty and fashion retail still is very important to us. Superdrug has been a key growth account for us over the past 12 months, as has Primark. And again, we're winning with those kind of businesses because the margin mix that we do with them is a lot healthier than what we do with traditional grocery. Discount high street is where we do a lot of branded work, and as you can see, that's gone from 13 to 11%. I could see that potentially reducing further over the next 12 months. Again, the whole face of discount high street, which has been very profitable for us for a long period of time, is changing again. A number of those retailers just aren't surviving, and the ones that are surviving, trading terms and what they now want in terms of margin is increasing and getting more complicated. So what was once a very simplistic, very successful trading channel for us is now one that we will rationalise moving forward as we move into more specialist and beauty retailers. So we're making sure that we keep our eye on margin and we're moving forward with the right kind of business, with the right kind of retailers. Export continues to do well. It's growing in line with the growth of our business. Again, the feature of export is margin. It is a much healthier margin business. We are also doing much better in export with some of our more premium positioned brand. So Curl Company, for example, is doing very well in export. And our focus moving forward with export is to continue with those more premium positioned brands. In terms of category mix, not a huge amount of change, but the key areas that are continuing to perform well for us are in line with those market dynamics that I outlined for you a few minutes ago. Skincare being a very big category and growth category, hair care continuing to grow, which has moved up to 23% for us, and then bath and shower, which has grown up from 16% to 20%. Bath and shower has predominantly grown in our private label sector, and that's again with Aldi and Superdrug and done very well. Hair care is predominantly driven through our brands. As you know, we do very well in hair care in our brands. And skincare continues to do very well in our private label and in our contract manufacturing. Fine fragrance is an interesting one. It's gone from 9% to 6%. We rationalised quite a lot of fine fragrance business that came out of Broad Oak. It just was not good business to have. However, there's a number of new things that are happening in fine fragrance and contract manufacturing that will change the shape of that again moving forward into the next year. Key challenges for us moving forward, and I've said it several times during the presentation, is climbing that margin ladder. We're doing very well in sales. The onshoring, because of Brexit into the UK, is having a really good impact on our sales growth with key retailers, also with contract manufacturing in terms of some people bringing contract manufacturing back into the UK. What's important for us now is that we focus on our margins. We're going through a big rationalisation process in all 3 divisions at the moment and looking at what's delivering and what is not delivering and adjusting it one way or the other, either dropping that business, increasing prices, or manipulating it in a way that it makes a lot more sense for us moving forward. So absolutely the next 12 months is focused on margin and moving that in the right direction. Management of the UK discount sector and UK grocers is a large part of that and reducing our dependency there. It is already reducing. We are already outstripping, like I said, what we're doing with Aldi and the like compared to what we're doing with the traditional grocers. So it's just a matter of moving that business in the right direction. Increased development investment in higher positioned brands. Curl Company and Feather and Down obviously are 2 of those. Feather and Down has completed its first year exclusive with Boots. We launched this time last year. It's gone very well. We've done just shy of £1 million at retail in year 1. That was just out of 130 stores and 2 shelves in Boots. We've just gone up to 300 stores in Boots with 3 shelves, so Boots are very happy with the performance. Goal, and again, not a forecast, an aspiration, is to do 2 million at retail over the next 12 months. We're launching with another major retailer in December of this year, so we'll be extending the distribution of Feather and Down in the UK over the next year, and it's building really quite nicely. So we're very happy with the performance of that so far. We also have another premium brand launching in October of this year. We have 2 export customers that are already committed and 1 customer in the UK with a brand new hair care brand called Beautiful, where our retails are going to be between £10 and £25. So we're really moving up the scale in terms of retail positioning, and that's the continued goal that we have. Curl Company has been around for about 5 years now, has traded very steadily, but we now have finally, after trading for 3 years in Boots in only 90 stores, we've moved up to 780 stores, and they now want to take us to 1,300 stores. So Curl Company is doing very well with Boots. Key driver here is we're bringing new customers to Boots. And a key factor with Feather and Down, Curl Company and Beautiful, which is focused on hair loss, a natural solution for hair loss in women, is that we're focusing on need states. So we're focusing on brands which are solving a problem that people are seeking, particularly on the internet or when they go and buy products. So curly hair, sleep issues and hair loss. And we will continue with ideas that we have in the pipeline to look at brands that are focused on a need state and well-being. I think that's a big driver in health and beauty moving forward, is well-being. Ongoing export development. USA is now on the agenda. As you know, we traded very successfully in the USA some years ago and sold both of those brands, The Real Shave Company and Twisted Sister. We've really been waiting to have the right brands in our portfolio to go back into the US market. I've just spent a week out there a few weeks ago, opening doors and looking at the US market again. I think definitely with Feather and Down, Beautiful and Curl, we've got the right kind of brands and the right kind of positioned brands to go back into the US market. So that is a key focus for us over the next 12 months. And as Paul highlighted, we have a continued appetite for acquisitions, assuming it's the right one at the right price and it's the right fit for our business. I think just to add to that in terms of the journey continuing, one of the key challenges that we definitely have, and Bernard alluded to it in his introduction, is the supply chain in the UK. There is definitely pressure within raw materials and components supply in the UK. Component supply has been rationalised in terms of lots of acquisition activity over the past probably 2 years, which has resulted in one key supplier owning a lot of the capacity for bottle and jar manufacturing. They've had some issues, which has pushed lead times out. It has had a big impact on us in terms of how we can fit that within our capacity. But we are managing that very positively moving forward, but it's been a challenge. And I can see that continuing as the next 12 months evolves. I think, you know, the additional business that's coming into the UK market, some of the supply chain has just not set itself up right yet to be able to cope with that. And we've got various plans in place in terms of how we're going to address that to make sure that it doesn't impact on our business moving forward. But I think the exciting thing about our category is it's continuing to grow and we're outstripping that growth. We continue to keep ourselves flexible and aligned with speed I think that's important. The reason we have grown so significantly with Primark, Aldi and Superdrug is that we've been able to bring key trends and key product formats to market very quickly. So we're satisfying that consumer need for fast fashion and fast beauty. And I think that's a really important dynamic. And we will continue to ensure that we have within our team people that understand the market, understand the consumer, and we can move very quickly and adapt to what the change is happening in the market. And I think that's how I'd summarise how we're able to take advantage. So, you know, we will keep an eye on how those retailers are evolving, how they're evolving with this category, and continue to take advantage of the growth that's happening there. So thank you very much. And now we're open for questions.
Can you, sorry, I'm struggling to understand a bit what happened between the profit warning and the results. The profit warning seemed to be, we've got so many sales, we're struggling to produce them. The actual results, you seem to have £600,000 more sales than you were estimating in February, but then pre-tax profit was 120,000, at least higher than we're saying. So,
sorry, I think the main thing, I suppose there's two or three factors in those sales periods in that period. We've talked about Superdrug. Superdrug effectively put more stock into their store distribution, so they increased the number of facings that we had in their stores, which brought in an unexpected sales demand onto us and sales. Now, some of that was a one-off. In there, it was a pipeline fill that wasn't anticipated. They didn't tell us it was happening till it happened. But what's actually happened is that the actual sales per store went up as a result of that, and we had then a follow-on with increased sales going through. Again, another major customer, Asda. They always do a baby event every year, and we had anticipated that taking place, but they actually kept that on for a lot longer. So the promotional activity they did in that last couple of months of the year, February, March time, meant that we took a lot more sales, a lot higher sales than we anticipated. And the third item was actually export sales generally. We had a very good month in April. Again, that we hadn't quite anticipated the same scale at the time. We looked way back in January and we started looking at what the outturn would be.
So it kind of refers to those spikes that Bernard said in his introduction. There's some key customers, Superdrug, and there's an Aldi impact there as well, actually. In those last 2 months, Aldi put some business our way we did not anticipate. So we've got retailers that are moving really quickly with very little information. Superdrug's a good example of that. Aldi is another one. They loved what they saw that we had presented, and they just suddenly decided to do another special buy at a very quick late notice that we didn't even have in our forecasts or anticipate.
Is that the basis of your
sales profitable rather than the previous spike in sales, which seemed to have been almost unprofitable because you had to outsource the manufacturing?
Well, in the first place, we issued the note to stock exchange, not truly as a profits warning, but saying that we were in a position of risk, which seems to me to be the thing that a responsible company does. So if the level of sales increased to the point where the manufacturing capacity and the warehousing capacity and the whole production system is beginning to grind to a halt for lack of room, you feel you're at risk. So it made sense to issue that. But the first thing we did, we automatically take action on that. So it cost us another 300,000. We never missed a delivery to a customer. We still maintained our high performance, which is about 99% with the private label. And that was the important thing for us, to keep the business intact whilst we solve the problem. And we've solved the problem now. For example, our current order book would require us, and we will be trying to get out 4.5 million in July and 4.5 million in August. That's a heck of an increase. It's the way the business comes in. You know, you can't dictate to Aldi that don't onshore. But when they do, you take the opportunity, particularly when it's a reasonably good margin business. So the business we're having from Aldi, the business we're having from export and other customers, in fact, our performance leaves us open to people coming to us when they can't get it anywhere else. And I think we're better performers than the other competition in the UK for private label and for contract manufacturing. So I feel we protected our customer base. It's increasing, but we can now pick and choose a lot more that we'll get the right margin product. I don't know if that answers your question, but it truly, it wasn't so much a profits warning as saying we're in high risk here and we've got to solve a problem. Hopefully, we have solved it.
I guess your business moves in, from one sector to another, and you were mentioning earlier that the discount high street sector had declined quite a bit. Maybe you could say a bit more about, I guess the various pound shops and also the other ones that have taken, quite a lot of your products in the past. Why are they not so much anymore?
I think the ones that are suffering, and obviously you would have seen Pound World being the latest victim in terms of not surviving, is the single price point proposition appears to be the issue for a lot of those. I mean, Poundland, you would have seen, has had its own issues with the Steinhoff Group and everything that's going on there. And in fact, Poundland has moved away from single price points. So as much as they say they're a pound shop, they've actually moved away from that. So the ones that have never had that single price point proposition, so Home Bargains, Tommy Morris, B&M, are still doing incredibly well and still doing very well with us. And they're also ones that we can work with a lot closer in terms of moving the proposition out of that pound price point or other price points so that we can make better margins. So, for example, Home Bargains, who continues to be an excellent customer, we're continually working on new propositions with new sizes, new price points, and different ways that we can continue to move the market forward and drive more margin into the product for both him and us. So yes, I suppose we've really come out of a lot of those single price point because there's just no movement. They're not able to take price increases, they're stuck, and they're either not surviving or not growing. So that's the kind of element that has reduced for us. I don't know if that answers the question. Yeah, it's the single price point that's the challenge. Yeah.
I was going to ask something about the relationship with all those pound stores, because clearly they're in a little bit of a bad way. How much do you monitor how much you're giving to them and making sure that your invoices are getting paid on time?
Oh, well, they're all credit insured. And the minute that Poundland got their credit taken away, we cut them right back.
Okay.
So we limit our exposure. In fact, the exposure that we have on them is so low that the sales is restricted, actually, but we've taken that decision. I'd rather restrict the sales and make sure that we're getting paid. So that would be Pound World. Fortunately, we had no exposure at all. I think it was about £250. I think that was all that was owed to us on Pound World. So yeah, I mean, we credit insure them, and the minute that they're not on credit insure, then we either stop it or we take a very limited view and keep it under control.
Great.
But you do know by the way they perform themselves and by the way they buy, how they're going, and it was obvious that
it was Pound World was obvious. Yeah, I mean, we could see it
we're
happening.
in diffs, and a lot of the others are very variable in the performance. B&M Bargains, Body Care, they're all up and down.
Factory.
The one that continues to perform is Home Bargains, TJ Morris. So we focus on that.
And going to the other extreme with the boots situation with Feather and Down, I went into one of the stores and couldn't get any because they'd sold out, which is great. So I felt that must be going well. Clearly it is. You've told us today that they're going from 90 stores to 300, I think you mentioned. What's the potential there to maybe get into every store, or will it be price point that's not good?
Every store with boots is not the goal because you have a diminishing return as you go into more stores. Interestingly, Curl Company's opportunity to go from 780 to 1300 is one that isn't necessarily, for me, a sales. It's more about exposure on the brand and seeing it in every door. Because once you get past an optimal number of stores with boots, and it is about 700, 750, actually the smaller stores don't perform. So 300 stores on Feather and Down, I would like to see it pushed to 450, 500. That would be the optimum. But beyond that, you actually don't get much gain. The point with boots is it's a great shop window. So internationally, when we went and showed it recently in the USA, a number of retailers in the USA had already seen it in boots. Clicks in South Africa, who are committed to taking Feather and Down, that'll be our first export customer, saw it in boots. So boots is that great shop window. And obviously 3 shelves is more important to me in 300 stores. And in fact, probably moving forward, if I could get 4 shelves or a full bay in 300 stores, that would probably be the better the better solution rather than keep pushing the numbers of stores. And we're still on QVC. We're still doing QVC with Feather and Down as well, which is a slow burn, but it's a great way to expose the brand. And as a result, QVC Germany have been in touch as well. So that might be a good entrant for us into the German market, which would be good.
So overall, I mean, you're saying the aspiration to get to 60 million turnover, but it sounds to me like if you have each of the brands that you've got really doing well and on full power, you might not need to make any sort of acquisition. You might get there without.
Yeah, that would be a stretch. That would be. I think we feel we could get over 50 million without an acquisition. But I think well, it'd be nice if something came along, and a prestige brand that we could afford. I think we'd want to have a go at it.
Can I just understand the capacity constraint that you had? If I understand, it's on the warehousing side. But can you just talk us through the whole sort of production line and where the capacity constraints might be in the future, and the cost implication of outsourcing? Because I would have thought one would have economies of scale if you were warehousing internally, whereas you've maybe now introduced a variable cost.
Well, I don't think we could manage to have dealing with the latter part first, the latter part of your question first. Warehousing was a real issue. We've got probably about 40,000 square feet of good warehousing, and it's totally for the way we do our business, and we're not intending to change that very much. So, for example, for Superdrug, which is a big customer, you hold 13-week stock at some level along the line, either component level or finished good level or whatever else. You can't give them a 99, and it's part of the contract with them. So, with those kind of customers, you need a lot of room, a lot of components. So, we probably use the 40,000 square feet in terms of holding components, and then find a contractor, and we have found one within 2 miles, who will then pick and pack your branded and some of the private label as well if it's necessary. So we've got a way, if we expanded really quickly, we could move our picking and packing out fairly quickly because they're already set up, trained and tested on this. I don't know if that answers the question on the warehousing. On manufacturing, we have 3 or 4 bottling lines, 3 if you're very precise, and they say they average 60. They should work at 60 in theory. They actually work at 30 in terms of our efficiency on average per minute. And we've bought a machine now. We replaced one of those lines with a machine that does 100 a minute. So we're twice as fast. We're not more efficient, but we've doubled the capacity. We intend to do that with the tube filling, which doubles the capacity there. It goes twice as fast. We will increase efficiency eventually, so there'll be an extra bounce. But with that kind of investment within the 60,000 square feet that we use for manufacturing, we should be able to do twice as much as we did before. So we should be able to get the 60 million. If it's spread over bottles, jars and tubes, roughly in the same proportion, we should be able to get to the 60 million now comfortably. It was that leap to increase investment in a second shift and increase investment in machinery and improve the engineering backup, and also bring in improve the structure by bringing in a production manager and investing in training. So basically that's it. We have three lines, one of which goes twice as fast as it did before, and both of them now, or the 3 now, are on both shifts. Does that give you a flavour of what we're...
That's fine.
Yeah.
Thanks.
Just going back to Dave's question about your credit exposure to your customers, I'd, on the back of an envelope, worked out that your receivables had expanded from 58 days to 80 days.
No, if you look at the seasonality of the business and the profile of the business, it went up to 53 days. So when we look at, because of the big sales growth, if you look over the full year, you could do that. But looking at the quarter's sales on which the debtors are based, then the actual debtor days is 53. Part of that is a sales mix, got more export, slightly longer days. So the profile of the business is changing more towards 50 days. We did have a problem with one particular customer who partly operational in that they it wasn't a problem really. They didn't recognise our invoices by the time we realised. We then had to catch up and get the invoices zeroed through the system, which meant we had a slightly higher debtor position at the end of the year, which was corrected within a week of the year end.
If we go to our current situation, we're now coming into July and August, and if we achieve what we're setting out to achieve, we do 4.5 million in each of those months. So over the 60 days, we'd actually invoiced 9 million. And if you work that out, you'll find that it'll bring the total debtors within their normal, like boots in 60 days and export on 100 days or whatever it is, that'll be 9 million in turn. But if you work that back over it would look like 80 days, but it actually will only be, it should be down to 50 days by the end of August.
So we're still in control of debtors. I think, the export, most of our exports ex-works, we do have extended terms on that, but, we're getting the sale at the point they take the goods from the door. The other way would be, getting some sort of payment after shipment to Australia, which we judge as not the right thing to do. And we do, as we've said, we do credit control the majority of our sales debtors. And we're quite close at managing and involving the sales team as soon as there's any particular issue in terms of collecting anything. And that's our exposure and our history on losing money through bad debts is very, very low.
And just looking at your banking facilities, the accounts reference invoice discounting. Is that
Yes.
factoring, or is it a borrowing base? Asset-backed finance?
No, it's an invoice. It's an invoice finance facility. So
is that not costly?
It isn't in the way it's structured at the moment. We're paying about. It's not something I focus on. It's a 1.75 over base rate at the moment in the margins, and the fees are 0.1%. So it's quite a cheap way. We have an overdraft facility. We dip in and out of it. We don't utilise it. We will be doing now as we're building stock for this seasonal peak of sales, and that will drop away by October, November time as that money comes into the business.
It's useful to have it, but we don't use it all the time.
But we have that facility available should we need to. We're also utilising HP facility for some of the equipment we're buying, matching, if you like, the long-term capital expenditure with a longer-term finance structure.
When you say seasonal, will it not get busy again as you get towards?
We hope so.
Yeah,
yeah.
There is.
Well,
I was thinking about that.
Contract manufacturing, they're all preparing for Christmas now.
Yeah.
So there's a lot of stuff we're manufacturing for big brands that are putting stuff into gifting. So Wren is a good example of that. We're making, hundreds of thousands of units of Wren that they then packing off into gifts. So that adds a seasonal element because even though Christmas is 6 months away, the industry does Christmas now because they're preparing for it because everything has to be in store by September. So that's that big peak that particularly comes from contract manufacturing and private label. Branded sales is pretty static at this time of the year.
I often characterise the business as being a bit lumpy because we can get a one-off buy from Aldi, which will lump a lot of activity in a relatively short period of time. So there are spikes throughout the year, but there is a seasonal bias. We do some WIP, work in progress, for gift sets, for Wren, for boots, for example, under the Champneys range. So there's a little bit of that.
Paul has a bias as well. As a finance person, if he doesn't see an order in, he thinks that's seasonal, but actually the orders will come in September and October.
And
won't they, Pippa?
I mean, you've gone through a few sort of growth spurts and trials and tribulations, and we only see you guys, so I've got this vision in the manufacturing area, shall we say, that they've probably all been thinking, oh my gosh, we got all these big orders, we got to, you get the whips out, and they're all running around trying to do everything. How are they coping with the fact that you've now got new lines and new ways of doing things? Do they all need retraining? How are they coping?
That's a good question. Can I answer that, Paul? Because just on an overall basis, we brought in the new line, which goes twice as fast and probably a slightly less demanding from an engineering point of view. But we're using twice as many people to actually facilitate it for the time being as we bed it in. We would hope by the end of 3 or 4 months, with the investment of new machinery on down that production of the same production line, like capping, you need to cap you fill the bottles at 100 a minute, but then you need to cap them at 100 a minute. We do capping manually, so we'll have to invest in the actual, if you do 100 a minute, you need 4 people to do that, so it takes area to do it. But it's the same process as if you're going 30 or 100. Then you need to label it. The labelers need to be more efficient. And then you need to put it in boxes. So you need better machinery at the other end, which we intend to invest in over the next 3 months by bringing machinery out on loan and testing different ways to do it. So I would think that by the end of 3 or 4 months, we should have got that line probably has 13 or 14 people working on it. We should have that down to around 10. It'll not be totally twice as efficient as the previous, but it should be.
So 40%. You've got temporary staff in to help cope with the additional needs you have. Otherwise, people will think their jobs are going to go suddenly at the end.
No. Well, we have temporary people in. We've probably 30 temporary people in at one time, 30 to 40, so 20 in each shift. And we have 250 people there, so there's probably over 10%, give or take. But as we grow, we don't intend to stop growing, so we will need the people.
Okay. And if I could give you one wish each, because there's 3 of you, so 3 wishes, what would it be for the next year or so?
Longer holidays? No.
I'd like retailers, for me, to make my life easier is to have more vision from retailers. I think the example we gave of Superdrug, for example, who we won Supplier of the Year award this year, which was huge. And, that's over P&G and L'Oreal. I mean, it's a big deal, which was a phenomenal achievement from the team. And the reason we won it is because he said, we ticked all the boxes for everything that Superdrug's looking for. He said, but this supplier tells me that 99% service level isn't good enough. And we do. We say to Superdrug, we shouldn't be not delivering 1%. And that example of the big spike that we had with Superdrug, because they suddenly decided to double and triple face everything, we had no vision of that whatsoever. So I guess a wish for me would be, it's unlikely to ever happen, but more clarity, more transparency from retailers of all types would definitely make our business easier. And I guess my second wish would be is that our supply chain in the UK could sort itself out, because that's what causes us the most grief, is our supply chain and then lack of transparency from our customers, and we have to try and marry that. And we do a good job at it, it's hard work. Then we have these spikes.
So many wishes.
That's a lot of wishes. How many was that?
Take the time for you.
Yeah.
You got your...
Yeah.
I think that from my point of view, the operational aspect of the business, I think it's if we could magic fully qualified engineers into the country, and I think like a lot of manufacturing businesses in the UK, the skill base of engineering is, we're having to develop and grow our own, and that's a slow burn. But that isn't going to happen. So we've got to work on building our own skill base, and that would be an ideal solution, which isn't going to happen, frankly. So.
I would like to have a £5 million brand, be able to acquire it and bed it in, and become more of a flair player in the market. Because I know these guys can solve all the operational problems. It's just a piece of cake. It's just hard work. You have to work to midnight and all day long. But you can solve all the production problems if you're reasonably. But you cannot grab market share in branded unless you know what you're doing, or unless you you have the right kind of backing to buy a brand and bed it in. So that's and the other thing is to buy an e-tailer, because I think in 5 years' time, 50% of what's sold in health and beauty and well-being, just move it to well-being, will be on the internet.
How else are you marketing your own brand products?
The main way is through social media. The main way that we're doing Feather and Down is through social media and online. QVC is helping with that because it's giving us a lot of content that we can use. We work with a sleep expert, as I think I may have mentioned before, Dr. Narina. She's a good spokesperson for the brand. But that's our main thrust. Obviously, trade promotions in store and secondary sighting and exposure within store, but predominantly through social media.
So what about other brands? Apart from Feather and Down, your other own brand products?
Oh, exactly the same. I mean, Creightons hair care continues to do very well. It's been positioned in the UK in predominantly in the high street discount sector, albeit we are also in Tesco and Asda. We pulled it out of Morrison's because they wanted to take it below £1. So this is the dynamics we have to deal with. So it's about working with that. But yeah, we do the same there. It's doing very well internationally, and we have all of our international markets working on social media. We actually had some very interesting billboards on a main highway in Serbia recently, which were amazing. So it depends on your distributor. But, you know, some of them are very active, like Poland, where we do very well, and they do a lot of social media, a lot of promotions. So that's the main thrust of what we do.
So you mentioned about US. So for example, the specialists like Sephora and Utah, are you...
And Ulta's the... Yeah. Yeah, I mean, we're talking to Ulta for sure. I mean, that's my destination for that, for sure.
I mean, they've been doing so well.
Yeah, they're doing incredibly well. But there are other retailers in the US that are also doing very well. And believe it or not, health and beauty and grocery in the US is very healthy. I mean, there's people like Kroger and Albertsons and H-E-B that are doing very well. So it's about putting the right brands in the right places. But yes, the aspiration for something like Feather and Down and Bambeautiful, that is the hair loss brand, Ulta is absolutely our #1 target, for sure.
And how much exposure do you have to the likes of B&M and TK Maxx in the UK? They're opening like 50, 60 stores every year just in the UK alone. So are you looking to go into those?
B&M bargains? B&M?
B&M, yeah.
I don't know where B&M... They've got a great name, and they're definitely...
They're not trading
big players, but on beauty, they're not... Health and beauty, they're not...
And one way of you can assess that is if you walk into a home bargains store, the first aisle that you walk into is health and beauty, and he's got 3 aisles of health and beauty. You walk into a B&M, you have to go to the back of the store and be lucky if you can find 2 4-foot fixtures of health and beauty.
It's still
so B&M are in the news, but they're in the news mainly for food and non-food as opposed to beauty. So B&M have started to up their orders with us. They're beginning to look at some stuff that we've been doing. So whether or not they will... you know, grasp the beauty, but they're really up against home bargains who have it front of store and it's clean and it's smart. So I think they've got a long way to go before they're going to tackle the beauty. So a lot of what you hear about B&M isn't necessarily about the beauty.
And body care would be, you know, body care is a better customer than B&M
for sure
for us, because although they're much smaller,
they're beauty specialists.
They're beauty specialists, and they have a younger footfall.
A while ago, you said that capex to get up to this 60 million production would be 800,000. Has some of that been spent in 17-18, or is that still to spend? That
in April this year, so most of it's still to come. We have spent some, but the majority is still to come.
Well, that line cost 200,000, and we've committed to buying another £200,000 tube line, so that's a good part of it. And there are other.
Do you think that 800,000 is still a good number then, or could it be higher?
Well, at least it's going to be at least 800,000. I don't think
it'll be lower.
I think it makes sense to spend the money if we're going to stay in the business, if we're going to stay as private label suppliers and contract manufacturers. Yeah.
Right. And of the 299,000 sort of extraordinary spend for the outsourcing, given that you said it sort of carried on till May, does that mean that the number for this financial year is sort of like 100,000? Is that
no? It'll be below 100,000.
Right. Okay. And my last question, just on plastic, is that an issue for you?
On
plastic packaging, or?
Yeah, it is an issue. It's an issue as an aspiration for us to, along with other suppliers, we should be trying to get plastic out of the business as much as possible. Certainly the less sustainable, or whatever you call it, plastic. But also our export customers are insisting that we don't, for example, shrink wrap, and we put it in cardboard. So it is an issue. It's an issue we can deal with, but it's an issue.
It's relying on our supply chain, really. Some of them are doing quite well with new technologies, some are really behind. So we've got to kind of encourage them, as our customers are encouraging us, to invest in solutions, whether that be post-consumer recycled plastic. We're working with bamboo on tubes, for example, with some retailers, and more sustainable sources. But there's a long way to go for UK supply chain to get plastic out of the health and beauty industry, for sure. There's a long way to go.
Well, it's also the retailers themselves. They have got to have some determination about it and give some guidance as to
Stop
what
asking
they
us to
want.
put it in plastic trays, for example.
Yeah, absolutely. Yeah.
Which we're fighting all the time.
But if they say it, we do it and worry about it later.
I can't remember who your broker is, and I'm just thinking that if you're to do an acquisition, then you might need some institutional shareholders.
Why?
Support.
Why, Bruce? We haven't got a broker.
Okay.
Yeah, and I'm just wondering we've done a couple of acquisitions, small acquisitions. We didn't have a broker. We have a sponsor in Bowman Cornish. But actually, having gone around the traps and talked to lots of people, I'm not sure that we actually need one because we've got quite a lot of organic growth and we don't intend to buy anything more than 5 or 6 million. The key shareholder would like to stay in at 20%, so he's going to have to cough up, if we go out for 5 million, he's going to have to cough up $1 million of that, or 1.5, whatever 30% of 1.5 million of 5 million. And I think we can do that. But if it goes way beyond, and I think we can do that without, well, give me your opinion.
And the rest come from cash generation.
Pardon?
And the rest come from
generating.
Mm-hmm.
Yes.
Okay.
We've certainly got a fair amount of wherewithal within the facility at the moment, and a very supportive bank, should we need to.
I think we need a year to consolidate this growth we have that is spiky, but continuous, and it's presented challenges in manufacturing and warehouse, which we're addressing, and I think we need a year to get out of that, but be in a position to be able to do an acquisition should it come along at the end of the year or during the year, but preferably at the end of the year. And I'm not sure that getting involved, the amount of time we took up in going around and talking to brokers before we decided to do that, it kind of took our eye off the ball back at the ranch where the place was just bulging, and we had to, we got together we're a small team, so we can't do, I think we need just another year as we are.
How many institutions do you see on the roadshow, or do you do a little roadshow?
Yeah, we did the road show, and we saw institutions probably 2 or 3 times. Some of the institutions we probably saw 7 or 8. Yeah. We also saw funds as well, so probably maybe 5 or 6 brokers and 3 or 4 funds. All very interested and interesting. I feel we can pull that trigger when we need to. I don't want to sound negative, but the priority for us is to get the business really well over 5 or 6% bottom line, maintain the growth, and to increase the efficiency and get any stress out of it, or get as much stress out of it as possible.
And what about that return on capital? Your ambition of a 20% return on capital. Just listening to you, the 2 clearer present risks that you've stressed. One is your supply chain, and the other is what appears to be very limited visibility from your customers. They put in large orders, they change in their nature. Is the return on capital target of 20% achievable, do you think, within your time horizons, given those risks? Is that not the one target that you're most weak on?
Well, I think that's a good, yeah. We are facing challenges on that. I think that what we've done is filter out the good retailers in the retail market. So we're playing with the winners, but the winners are still like Aldi.
They're dynamic. They come and go.
No,
Yeah.
They're dynamic.
Well, they're dynamic, and
They come and go, but they're dynamic.
Yeah. So Aldi at the moment has gone through, I think, onshoring. I think it's a lot of that is about onshoring, and some of the others will be bringing back manufacturing into the UK as well. So some of the growth that we're experiencing is to do with Brexit and onshoring, some of it to do with growth of the business, and some of it's to do with the growth of e-tailers. We're hunting down e-tailers now, like Hut Group, Amazon, all the rest of it. So we're out there trying to find the winners and get them under our belt. I think we'll continue to we've reached, there's a critical mass, I think, in this business where you when you walk through the door, they want to talk to you, as distinct from 5 years ago where, who are you? And can you please come back some other day? We're very busy. You know, we get a different reception now, and we can present a case, and I think we can win business of a higher margin caliber more consistently.
Is that one of the reasons why when you were granted a wish, an individual wish, you wished for a £5 million brand that you could bed in? Is that?
Yeah.
Would that give you the greater certainty
that? What's the word? Prestigious brand. You know, an upmarket brand, a premium brand. I don't want. You know, we've got loads. We can do brands any day of the week, but brands that command the customer and command attention at Marks and Spencer's and Boots high end level is important for us.
What percentage of the business do we sell ourselves online, i.e. direct to customer?
Oh,
Tiny.
But we have invested in a digital manager.
Marketing manager, yeah.
We intend to. Well, actually, the only way through this I see really is acquisition, because to learn all the tricks of the trade that you need to learn to be a cult beauty or an Amazon lookalike or a cult beauty lookalike or whatever, or Beauty Bay, or, you know, these people are turning over 20 and 30 million in beauty and health.
I think I'm learning there's a misconception that e-tailing is not a resource-hungry channel. It's incredibly resource-hungry.
Yeah, and
it's the amount of people that have to sit behind the scenes to be successful online, in terms of constantly analysing the data, doing campaigns, constantly adjusting your pricing, constantly watching the competition. The learning for us that we've done by bringing on this digital marketing manager in the past 6 months is significant. So we will do more this year than we've ever done, but it's still a very small percentage, and we're learning. We're talking to lots of people externally in terms of trying to improve our learnings, but I do agree with Bernard, the curve is huge, and if there was an opportunity to buy into somebody that's gone through that pain already, then that would be attractive. But again, you saw the numbers. You know, by 2022, they're still saying only 11% will be sold online. So, okay, that's a 3 billion opportunity here in the UK, and we've got to be part of that. But bricks and mortar with the right retailers is still very much in play. I think what's also important to note is that not all types of products sell online. There's certain categories that do very well. Not everything sells online successfully. So again, it's about making sure that we've got the right brands and the right price position. And these need state brands, we're finding I've got a lot more potential than some of the other stuff that we do in terms of online. So that, you know, that's one of the dynamics we're looking at. So we're learning.
Great. Thank you.
Okay, thank you.
Thank you. Thank you very much, everybody.
Thank you.
It's been a pleasure. Thanks a lot.